Good evening, everyone. I want you to imagine something with me for a moment. Picture yourself 30 years from now. You've worked hard, put in the hours, raised a family, or maybe pursued your passions. Now it's time to retire. It's the golden chapter of life, where you should be free from the worries of a paycheck and the daily grind. But here's the critical question. Will you have enough to truly enjoy that chapter? Many people, just like us, start their working life with high hopes. They save, they invest in their company's 401k, they put a little money aside in a savings account. But over time, inflation creeps up, medical bills appear, and suddenly, retirement doesn't look as secure as we once imagined. That brings us to today's conversation, stock appreciation, and how it can be a powerful, yet often misunderstood ally in your journey toward financial freedom in retirement. Let me tell you a story about two individuals, Mary and Tom. Both are in their early 30s when they begin their careers. Both are diligent savers. Mary decides to put her savings into a bank account with a modest interest rate of around 1–2%. Tom, however, learns about the stock market. He decides to invest in stocks, specifically growth stocks in companies he believes will perform well over time. Now, the key difference between them isn't their savings habit, but where they choose to park their money. By the time they are 60 years old, Mary's savings have grown, but barely. Even though she saved diligently for 30 years, inflation and low interest rates meant that her money didn't stretch as far as she'd hoped. She realizes that her retirement may not look as comfortable as she once envisioned. Tom, on the other hand, experiences the ups and downs of the market. There were years where his investments dropped in value, but there were many years where they grew. More importantly, over the long run, his stocks appreciated significantly. Tom's retirement account didn't just grow, it multiplied. The magic of stock appreciation. What Tom understood was something very simple: stock appreciation. When you invest in a stock, you're essentially buying a small piece of a company. As the company grows and becomes more profitable, its stock price rises. This is appreciation. Let's break that down further. Imagine you buy stock in a company like Apple when it was still young, back in the late 1990s. Apple was a growing tech company with great potential. Now fast forward to today. The value of that investment would have skyrocketed as Apple became one of the largest companies in the world. That is stock appreciation in action. It's the ability for an investment to grow in value over time, and it's one of the most powerful ways to build wealth, especially for retirement. Why stock appreciation is critical for retirement. Let me share why stock appreciation is especially critical for retirement. Beating inflation. Inflation is like a silent thief. The money you have today will be worth less in the future if you don't invest it wisely. Stock appreciation helps you combat this. Historically, the stock market has outpaced inflation, helping investors maintain and even grow their purchasing power over time. The power of compounding. This is the secret sauce. Compounding means earning returns on both your original investment and the returns that investment has already generated. Over time, compounding can turn modest investments into significant sums. It's not about timing the market, it's about time in the market. Income in retirement. While stock appreciation grows your wealth, it also gives you flexibility. You can sell appreciated stocks to fund your retirement, or invest in dividend-paying stocks that generate a regular income, giving you cash flow even as you relax on that beach or play with your grandchildren. The ups and downs, a reality check now. Let me be real with you. The stock market isn't always a smooth ride. There will be dips. There will be crashes. And if you watch the news every day, those red numbers might give you some sleepless nights. But here's the truth. History shows that the market recovers. Let me take you back to 2008 during the financial crisis. The market plummeted and investors panicked. But those who stayed in the market, who didn't pull out of their investments, eventually saw their portfolios recover and thrive. The same pattern repeated itself after the COVID-19 crash in 2020. Long-term investors not only saw their portfolios bounce back, but they also enjoyed significant gains in the following years. This is what Tom knew. He didn't panic when the market dipped. He trusted in the long-term potential of his investments. Over time, the market moves upwards, and patient investors are rewarded. Creating your path. Diversification is key, but you might wonder, what if I pick the wrong stocks? What if the company I invest in doesn't grow? That's a valid concern. This is where diversification comes in. It's like not putting all your eggs in one basket. You spread your investments across different sectors, industries, and even countries. That way, if one stock doesn't perform well, others in your portfolio might balance it out. For most of us, individual stock picking can be tricky. That's why many turn to index funds, investments that track the overall market. These funds spread your money across hundreds, sometimes thousands of companies, reducing your risk while still allowing you to benefit from stock appreciation. The story of compound growth. A real example. Let's dive into a real-life scenario. Meet Sarah. At 25, she decided to invest $200 per month in an S&P 500 index fund, which is a collection of 500 of the largest companies in the U.S. Over the past few decades, the S&P 500 has returned, on average, about 7% annually after adjusting for inflation. Now Sarah is consistent. She continues investing $200 each month for 40 years. By the time she turns 65, do you know how much she has? Over $500,000. That's the power of long-term stock appreciation, combined with consistent investing and compound growth. This isn't a get-rich-quick story. This is a get-rich-slowly and steadily approach, and it works. How you can start today. You might be thinking, this sounds great, but I'm already in my 40s or 50s, or maybe I don't have a lot of money to start with. The good news is, it's never too late to start. Begin with what you can. Even small amounts invested regularly can grow over time. Choose low-cost index funds or ETFs if you're not comfortable picking individual stocks. Automate your investments. Set it and forget it. Let the market work for you while you focus on living your life. Conclusion: securing your future stock appreciation isn't a guarantee. It's a tool, a powerful tool that, when used wisely, can help secure your retirement. It requires patience, discipline, and a long-term mindset. But when I think of Tom's journey, or Sarah's path to $500,000, I'm reminded that building a secure retirement isn't about luck. It's about making smart, informed decisions today, so that tomorrow you can live the life you deserve. So I ask you, how will you secure your future? Will you rely on what's safe but stagnant? Or will you trust in the long-term power of stock appreciation? The choice is yours, and your future self will thank you. Thank you.